The United States stock market is currently closed, and as of the final closing bell on June 29, 2026 at 4 p.m. Eastern Time, BigBear.ai Holdings Inc., trading under the ticker symbol BBAI, finished the normal trading session at exactly $3.60 per share. This represents a solid single-day upward bounce of 3.44% from its previous close, recovering slightly from an intraday low of $3.45 before tapping an afternoon high of $3.65. While a short-term green day offers a brief sigh of relief for retail investors tracking their retail accounts, the underlying movement tells a vastly different story than a simple single-day relief rally. If you look at the monthly data leading up to this point, BigBear.ai has been bleeding out significantly, dropping nearly 20% over the last 30 days and heavily underperforming the broader technology sector. The recent bounce seems less like a fundamental shift and more like shorts covering near critical support levels or speculative traders using automated algorithms to scalp short-term momentum. To understand why this divergence between daily ticks and monthly trends exists, we have to look past what the general public sees on standard charting platforms. The surprise development that many retail participants missed is that behind this modest 3% gain lies a massive wave of internal capital restructuring and institutional repositioning. While amateur traders were simply watching the green candle on their mobile dashboards, large institutions were quietly adjusting their positions due to recent shareholder approval for expanded share issuance. This newly approved ability to issue more equity has created a massive dark cloud over the stock, as the threat of equity dilution hangs heavily over anyone buying at these levels. The hidden angle here is that BigBear.ai is burning through its cash reserves far faster than its current contract backlogs can offset, meaning that this slight price bump is likely the calm before a highly dilutive storm. The common consensus among casual market participants is that any stock with artificial intelligence in its name is an automatic ticket to massive wealth, especially given the historical trajectory of mega-cap leaders like Nvidia stock. People open up their retail trading accounts, look at micro-cap software firms, and assume that these smaller entities will inevitably trace the same exponential growth path as the dominant silicon and data center infrastructure plays. The general narrative suggests that because BigBear.ai secures Defense Department contracts and provides predictive analytics, it is a guaranteed long-term winner sitting at an attractive discount. Retail forums are filled with discussions suggesting that a $3 stock has nothing but upside, viewing the current low price as a golden opportunity to accumulate cheap shares before an inevitable mainstream breakout. However, looking deeply at the real numbers forces a complete rethink of that narrative. The reality is that treating a highly speculative, cash-burning microcap contractor like a premium technology infrastructure leader is a dangerous mistake. Unlike the megacaps that generate tens of billions in free cash flow, BigBear.ai operates with a negative net profit margin that recently hovered around negative 226%. When you evaluate the broader ecosystem, comparing this asset to the stability of Apple stock or the structural growth of Tesla stock reveals the massive risk profile hidden inside undercapitalized microcaps. Investors often turn to a modern, intelligent portfolio or seek professional investment help to build an optimized individual brokerage account, yet speculative stocks like this frequently bypass traditional risk management frameworks, leaving self-directed traders exposed to extreme volatility. Recent price fluctuations highlight this systemic weakness as the asset has spent the first half of 2026 trapped in an aggressive downward channel. The trading volumes during down days have consistently outpaced the volume on up days, indicating that institutional distribution is actively occurring while retail traders absorb the selling pressure. This retail absorption is happening across major modern consumer platforms, with individuals buying up fractional shares through specialized tools like Robinhood fractional shares, or adding to their portfolios via the main Robinhood app. While the ease of modern online retail trading has democratized access to the stock market, it has also concentrated high-risk speculative retail positions in names that lack structural institutional backing. When institutional activity is analyzed through regulatory filings, we see a clear pattern of caution that contrasts with retail optimism. Major funds are keeping their exposure minimal, preferring to allocate capital into highly stable instruments like Fidelity ETFs or diversified Fidelity mutual funds, rather than taking direct equity stakes in micro-cap software providers. This institutional hesitation is directly tied to the company's balance sheet constraints and the underlying mechanics of government contracting. Government agreements are notorious for delayed payouts, complex compliance audits, and thin initial margins, meaning that even a massive headline-grabbing award does not instantly translate into available cash on hand. For individual investors executing a strategy of self-investing through popular online investing platforms, navigating these wild swings requires a deep understanding of macroeconomic pressures. The high interest rate environment of recent years has made capital acquisition incredibly expensive for small-cap firms. When a company can't easily borrow from traditional credit markets, they are forced to turn to public equity markets for capital, which brings us back to the dilution concerns currently driving the stock's long-term downward pressure. If you are utilizing advanced platforms like the Interactive Brokers platform to execute short-term options or direct equity trades, you can see the implied volatility pricing in massive moves around upcoming earnings dates, reflecting the deep uncertainty Wall Street holds regarding the firm's path to profitability. Take a moment right now and weigh in on this complex situation by dropping a comment below stating exactly how many shares of BigBear.ai you currently hold in your portfolio, or if you are completely avoiding this asset in favor of more stable corporate giants. To look closely at the core mechanics of the business, BigBear.ai operates primarily as a provider of operational artificial intelligence, machine learning, and advanced analytics for national defense, domestic security, and complex commercial enterprise operations. Their entire business model revolves around taking massive, messy, unstructured datasets and processing them through their proprietary software suites to deliver predictive outcomes and situational awareness. They build software solutions designed to assist military commanders, supply chain logistics managers, and corporate executives in making high-stakes decisions under pressure. Rather than offering consumer-facing tools, they act as a specialized defense contractor and enterprise software vendor, relying on a small number of large-scale, high-value client relationships to generate the vast majority of their annual revenue. When analyzing their historical performance and older corporate reports, the financial structural challenges become entirely clear. Looking back at their financial reports from recent years, their annual revenue has largely remained stagnant, stuck in a tight band between $125 million and $155 million, without showing the explosive compounding growth typically expected of a software-as-a-service provider. Meanwhile, their net losses have historically fluctuated wildly, occasionally reaching massive depths due to non-cash impairment charges, high stock-based compensation, and heavy integration costs from corporate acquisitions. For instance, their first quarter results for 2026 showed a revenue figure of $34.4 million, which, while accompanied by a slight improvement in gross margins to 34%, still underscored the slow, grinding nature of their revenue realization. This brings us to the core conflict between market expectations and corporate reality as we evaluate the future outlook for the company. The expectation is a fast-growing, high-tech defense contractor poised to surf the global wave of enterprise software demand alongside market legends. The reality is a struggling, highly speculative small-cap entity dealing with severe financial constraints, low institutional ownership, and the imminent threat of shareholder dilution. While the single-day gain to $3.60 showcases the stock's capacity for rapid, volatile bounces, the long-term trend demands extreme caution. Success in managing such positions relies entirely on objective data analysis, a clear understanding of cash burn metrics, and a refusal to fall for emotional internet hype. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thank you for watching. Please like, comment, and share this video to support the channel. Don't forget to smash that subscribe button.